This video provides an overview of the major concepts covered in Chapter 9, Mortgage Markets. Mortgages are securities used to finance real estate purchases. The mortgage markets serve individuals or firms that need long-term funding to purchase real estate. They also serve financial institutions that wish to act as creditors by lending long-term funds for real estate purchases. Chapter 9 is comprised of 5 key learning objectives. First, to provide background information on mortgages. Second, to describe the common types of residential mortgages. Third, to explain the valuation and risk of mortgages. Fourth, to explain mortgage-backed securities. And fifth, to explain how mortgage problems led to the 2008-2009 credit crisis. Let's begin with some background on mortgages. A mortgage is a form of debt created to finance investment in real estate which is secured by property. The mortgage represents the difference between the down payment and the amount to be paid for the property. The mortgage contract specifies the mortgage rate, the maturity, and the collateral that backs the loan. Most mortgages have a maturity of 30 years, but 15-year maturities are also available. Financial institutions, such as savings institutions and mortgage companies, serve as intermediaries by originating mortgages. They consider mortgage applications and assess the creditworthiness of the applicants. The originator charges an origination fee when providing a mortgage. In addition, if it uses its own funds to finance the property, it will earn profit from the difference between the mortgage rate that it charges and the rate that it paid to obtain the funds. This exhibit illustrates the means by which mortgage markets facilitate the flow of funds. Financial intermediaries originate mortgages and finance purchases of homes. These financial intermediaries obtain their funding from household deposits as well as by selling some of the mortgages that they originate directly to institutional investors in the secondary market. These funds are then used to finance more purchases of homes, condominiums, and commercial property. In the secondary market, mortgages may be purchased by savings institutions, commercial banks, insurance companies, pension funds, and some types of mutual funds. This exhibit summarizes the participation by financial institutions in the mortgage market. When financial institutions consider mortgage applications, they review information that reflects the prospective borrower's ability to repay the loan using the following criteria: level of equity invested by the borrower's income and debt levels, and the borrower's credit score. Mortgages can be classified in various ways, but 2 important classifications are prime versus subprime mortgages and insured versus conventional mortgages. Borrowers who obtain prime mortgages satisfy the traditional lending standards. In particular, they have low debt-to-income ratios and high credit scores. Subprime mortgages, on the other hand, are offered to borrowers who do not qualify for prime loans because they have relatively lower income or high existing debt, or because they can only make a small down payment. Federally insured mortgages guarantee loan repayment to the lending financial institution, thereby protecting it against the possibility of default by the borrower. Conventional mortgages are not federally insured. However, they can be privately insured so that the lending financial institutions can still avoid exposure to credit risk. Now let's move on to discuss the major types of residential mortgages, starting with the fixed-rate mortgage, which locks in the borrower's interest rate over the life of the mortgage. Given the maturity and interest rate on a fixed-rate mortgage, an amortization schedule can be developed to show the monthly payments broken down into principal and interest. During the early years of a mortgage, most of the payment reflects interest. Over time, as some of the principal is paid off, the proportion of the payments devoted to interest decreases. An adjustable rate mortgage, or ARM, allows the mortgage holder to adjust the interest rate paid by the borrower to market conditions. Because the interest rate of an ARM moves with the prevailing interest rates, financial institutions can stabilize their profits when they make these types of loans. If their costs to funds rise, so does their return on mortgage loans. For this reason, ARMs have become very popular over time. A graduated payment mortgage, or GPM, allows the borrower to make small payments initially on the mortgage. The payments increase on a graduated basis over the first 5 to 10 years of the loan, then level off. A growing equity mortgage is similar to a GPM in that the monthly payments are initially low and increase over time. A second mortgage can be used in conjunction with the primary or first mortgage. Some financial institutions may limit the amount of the first mortgage based on the borrower's income. A shared appreciation mortgage allows a home purchaser to obtain a mortgage at a below-market interest rate. In return, the lender providing the attractive loan rate will share in the price appreciation of the home. Finally, a balloon payment mortgage requires only interest payments for a 3 to 5 year period At the end of this period, the borrower must pay the full amount of the principal, which is called the balloon payment. Next, let's look at how mortgages are valued. The market price, or PM, of a mortgage should equal the present value of its future cash flows. Because the required rate of return on a fixed-rate mortgage is primarily driven by the prevailing risk-free rate, RF, and the risk premium, RP, the change in the market price, PM, of a mortgage can be modeled as shown. An increase in either the risk-free rate or the risk premium on a fixed-rate mortgage results in a higher required rate of return when investing in the mortgage, which causes the mortgage price to decrease. Mortgages are subject to three types of risk: credit risk, interest rate risk, and prepayment risk. Credit or default risk represents the size and likelihood of a loss that investors will experience if borrowers make late payments or even default on their loans. Financial institutions that invest funds in mortgages can hedge their exposure by purchasing a credit default swap, or CDS, which is a privately negotiated contract that protects investors against the risk of default on particular debt securities such as mortgages. Credit default swaps are priced to reflect the likelihood of default. Like most forms of insurance, the annual cost to the buyer of a CDS is positively related to the likelihood of a bad outcome. Some financial institutions are motivated to sell CDS contracts if they believe that the underlying debt securities will not default, just as insurance companies are willing to sell flood insurance if they believe a flood is very unlikely. Financial institutions that hold mortgages are subject to interest rate risk because the values of the mortgages tend to decline in response to an increase in interest rates. Prepayment risk is a risk that a borrower may prepay the mortgage in response to a decline in interest rate. This type of risk is distinguished from interest rate risk to emphasize that even if investors in mortgages do not need to liquidate the mortgages, they are still susceptible to the risk that the mortgages they hold will be paid off. The next key concept in the chapter relates to mortgage-backed securities. To securitize mortgages, a financial institution, such as a securities firm or commercial bank, combines individual mortgages into packages. When several small mortgage loans are packaged together, they become more attractive to the large institutional investors, such as commercial banks, savings institutions, and insurance companies that focus on large transactions. There are 5 common types of mortgage-backed securities: GNMA, or Ginnie Mae mortgage-backed securities, private label pass-through securities, FNMA, or Fannie Mae mortgage-backed securities, FHLMA, also known as Freddie Mac participation certificates, and collateralized mortgage obligations, or CMOs. The valuation of mortgage-backed securities is difficult because of the limited transparency involved. Unlike for other securities such as stocks and treasury bonds, there is no centralized reporting system that discloses details on the trading of MBSs in the secondary market. When deciding to purchase an MBS, institutional investors may rely on rating agencies such as Moody's, Standard & Poor's, or Fitch, rather than attempt to conduct their own valuation. When financial institutions believe they will incur a loss on an MBS or any other long-term asset, they are expected to write down the value to reflect the true market value, also called the fair value. The last major concept in the chapter relates to the credit crisis in 2008 to 2009. Between 2003 and 2006, mortgages were originated by numerous financial institutions without adequate credit screening, ultimately resulting in foreclosures by homeowners that could not make their payments. This caused a massive increase in the number of houses on the market by institutions looking to make up their foreclosure losses, and thanks to the laws of supply and demand, the increased supply of houses resulted in a substantial decline in market values, in many cases below the related mortgage amount, causing homeowners to simply walk away from their homes. This led to the credit crisis of 2008 and 2009. The credit crisis had numerous impacts, including Fannie Mae and Freddie Mac, which were both left with properties that had a market value substantially below the amount owed on the mortgages that they held. Because of their poor financial performance in the summer of 2008, Fannie Mae and Freddie Mac were incapable of raising capital to improve their financial position or to continue their role of supporting the housing market. In September 2008, the U.S. government stepped in to take over the management of Fannie Mae and Freddie Mac before they generated more losses and placed more pressure on the already fragile financial system. Many large financial institutions had heavy exposure to mortgages and were adversely affected by the credit crisis, including Bear Stearns, Lehman Brothers, and American International Group, AIG. The impact of the credit crisis extended far beyond the homeowners who lost their homes and the financial institutions that lost money on the mortgage investments. Insurance companies that provided mortgage insurance so that homeowners could obtain a mortgage incurred large expenses from many foreclosures because the property collateral was worth less than the amount owed on the mortgage. In this way, the problems of the mortgage sector spread to the insurance industry, illustrating a perfect example of systemic risk. In addition, although much of the credit crisis originated in and affected the United States, the problems proved contagious to international financial markets as well. The credit crisis illustrated some important problems in mortgage markets. Various participants in the mortgage financing process bear some of the responsibility that led to the crisis, including mortgage originators that originated poor quality loans to homeowners that were simply not creditworthy. The credit rating agencies, which are paid by the issuers of mortgage-backed securities to rate these securities, were criticized for being too lenient during the run-up to the credit crisis. Securities firms, commercial banks, and other financial institutions that packaged the MBS could have verified the credit ratings assigned by the credit rating agencies by making their own assessment of the risks involved. The institutional investors that purchased MBS also played a significant role in the crisis because they didn't conduct their own due diligence on the quality of the securities, instead choosing to rely solely on the credit rating agencies. The institutional investors that insured mortgage-backed securities also bear some of the responsibility, because MBSs that contained insured mortgages provided a slightly lower return to investors to reflect the fee paid to insurers, but were perceived to be safe and were easier to sell to investors. However, the inaccurate information of the home buyers ended up insuring fraudulent mortgages. Finally, speculators in credit default swaps were highly criticized for capitalizing on the collapse of the mortgage market. In an effort to stimulate the market for homes and mortgages and reduce the number of foreclosures, the U.S. government implemented various programs such as the Housing and Economic Recovery Act of 2008, which enabled some homeowners to keep their existing homes, thereby reducing the excess supply of homes for sale on the market. As the credit crisis intensified, many investors became unwilling to invest in mortgage-backed securities because of the risk of continued defaults. Thus, financial institutions that had large holdings of MBSs could not easily sell them in the secondary market. The Emergency Economic Stabilization Act of 2008, also referred to as the Bailout Act, enabled the Treasury to inject $700 billion into the financial system and improve the liquidity of these financial institutions. A key part of the act was the Troubled Asset Relief Program, or TARP, which allowed the Treasury to inject capital into large banks by purchasing the bank's preferred stock, thereby cushioning them against expected loan losses. Finally, in July 2010, the Financial Reform Act, formerly called the Dodd-Frank Wall Street Reform and Consumer Protection Act, was implemented. One of its main goals was to ensure the stability in the financial system by mandating that financial institutions granting mortgages must verify the income, job status, and credit history of applicants before they approve applications. Other goals included identifying risks within the financial system and to make regulatory recommendations that could reduce those risks, to ensure financial institutions that sell mortgage-backed securities to retain 5% of the portfolio unless the portfolio meets specific standards that reflect low risk, and to establish new rules intended to ensure that credit rating agencies provide unbiased assessments when rating mortgage-backed securities.